Investor Kevin O'Leary is incredibly successful and estimated to be worth over $400 million. He's best known for his role in the hit show Shark Tank, of which I'm a big fan. However, what you may not know is that Kevin loves investing for dividends. So much so that he launched his own ETF focused around quality dividend-paying companies. Throughout this video, I will explain why Mr. Wonderful loves dividend stocks and analyze his O'shares Dividend ETF. My name is Zach, and you should leave a like and subscribe to the channel if you enjoy the video. Today, I want to show you why Kevin O'Leary prefers investing in dividend-paying stocks and give an overview of the ETF he designed specifically to do so. Rather than have me explain Kevin's philosophy, it's better to hear it from Mr. Wonderful himself.
My mother used to take a third of her paycheck and put it into large-cap dividend-paying stocks and corporate credit back in the early 60s. And when she died, this portfolio had existed for 50 years. And as an executive, the first time I got to look at it, she'd hidden it from both of her husbands. It was amazing. If dividend-paying stocks and corporate credits over 50 years, you can't find an index that beats that. And so when I started to do some research, I found out one interesting fact that changed my investment philosophy forever. Over the last 40 years, 71% of the market's returns came from dividends, not capital appreciation. So rule one for me is I'll never own a stock that doesn't pay a dividend, ever. If you look at the volatility in the market around names that don't pay dividends, they're extremely volatile because there's no cushion of yield. What's the value of a stock that never returns capital to its shareholders? I don't know. Because the only way you can make money is if somebody else is willing to buy that position at a higher price for some emotional reason, perhaps, or for some, foresight that maybe the company will return capital one day. And I think of, when you learn as an investor over multiple decades is the only thing that matters is free cash flow. That's it. There is no other reason to own a stock. And with that philosophy, it brings you into a place where you focus on a company's ability to generate incremental cash flow, because just owning a dividend-paying stock is not good enough. Because, let's say we find a stock today that's paying a 3% dividend yield, and tomorrow, because its forecast for sales get cut in half, the stock drops by 50%. Now it's yielding 6%. I don't want to own that stock either. So my tests in this index that I've created with FTSE Russell looks at the balance sheet. Every year we test to make sure that the company is viable in its ability to generate cash. This is extremely conservative investing. This is for the long haul. These tools are not for, as you're suggesting, for spicy, the hot stock du jour. I've done that. I've been there. Let the young legs do that. I have zero interest in that. I don't care what the hot new stock is. When a company comes public, I won't own it either. It's got to prove to me over multiple years that it can continue to generate cash before it even fits into what I'm doing. So I'm really boring, and I like it that way. We're talking about real money here, the stuff that you need to preserve. When I think about my family trust, I can't afford to mess around with that. In my world, you never touch your principal. You adjust your spending habits, your gifts to charities, your use of capital based on how much you can generate from your portfolio. I view my portfolio and my trust and my positions as a chicken on a spit dripping cash. Everything has to generate yield, whether it's a fixed income position or an equity. The only reason it can be in my world is it's generating capital back to me. I take that, I disperse it. The family lives off that, the charities I've committed to. So I'm always looking for a company that can help me with my problem of generating more yield. I can't even imagine buying a stock that doesn't pay a dividend. Why would you do that? What would be the reason you would do that? I don't get it. So to me, that means about 28% of the market to me, is just speculation. A stock that doesn't pay a dividend is a speculation. It's not an investment. You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company. I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked. It's just a rotating door where management extracts capital, never returns any to shareholders. And I look at that and say to myself, why don't I just avoid that altogether? If it doesn't pay a dividend, I know that 71% of the time all the returns come from dividends. Why should I own a stock that doesn't pay a dividend? And I never will. You remember back in the late 90s, I'll use one example, Toys.com. I was an investor in Toys.com. I went to zero, never made any money. And I grew a little 4-inch Charlie Munger on my shoulder when that happened. And he appears, you can't see him, but he's on my shoulder every time I'm getting pitched a deal like Lyft or Uber. And Charlie says only one thing. If it has no cash flow, just say no. And I have listened to my little Charlie ever since the late 90s, and I've been right 100% of the time. This company is valueless. It doesn't have any cash flow. It's a speculation.
Let's summarize Kevin's major points. Cash flow is a priority when making an investment decision. This makes sense because positive cash flow is the only real way to return capital to shareholders. As Warren Buffett likes to remind people, a stock is just a small part of a business. Therefore, the principles that apply when buying a stock are the same if you were to own a whole business. You need to produce a profit and get a return on invested capital. As a business owner, if you can't generate positive cash flow, then you can't make money. The only other way is to sell the business to someone else for more, who themselves would hope to eventually see a return or sell it again. As Kevin says, this is just speculation. Ultimately, if your business has no path to generating cash flow, then it has no value to long-term shareholders. Kevin uses this line of logic to support investing in dividend stocks. A dividend is the only vehicle through which a shareholder can see a return without selling some of their position. He also mentions the stat that 71% of total market returns are from dividends, not capital appreciation. On top of this, a lot of what Kevin looks for in his investments is stability and diversification. It's for this reason that he designs his dividend ETFs with this in mind. I got a lot of comments on my most recent monthly update video asking about potential dividend ETFs. So today we're going to take a look at Kevin's US Dividend ETF, OUSA.
Hi, I'm Kevin O'Leary from Shark Tank and chairman of OShares ETFs. Many people ask me about investing and the ETFs I have in my portfolio. Here's how I invest in U.S. large cap stocks. OUSA, an ETF with over 100 large cap quality dividend stocks. It has given me great performance and dividend income. I don't want all the 500 biggest companies, just the higher quality companies. So I own OUSA. Here's the best part. I get performance that has kept up with the S&P 500 with 30% less downside during stress events. This is a U.S. large cap ETF that I helped build and is in my portfolio.
As Kevin alluded to earlier in this video, dividends are responsible for the lion's share of market returns. Why is this? It has to do with the principle of compound interest. Albert Einstein once stated, "Compound interest is the most powerful force in the universe." This is shown by the following chart. Since 1957, the price return of the S&P 500 is over 6,500%. The total return, which includes the impact of dividends and compounding, is over 46,000%. This means that approximately 80% of the hypothetical total return that an investor would have earned is attributable to dividends and compounding. To make this even better, profitable dividend-paying companies have the ability to maintain and grow their dividend payments over time. From 2010 to 2019, the dividends per share paid by the companies in the S&P 500 have more than doubled, with a growth rate of nearly 11% per year. Alright, so let's take a look at what companies are in OUSA. If you're a fan of my channel, then you may recognize some of these names. OUSA's top holdings as of December 2020 are Microsoft, Johnson & Johnson, Home Depot, Procter & Gamble, Merck & Co., Verizon, Pfizer, Apple, Cisco, Honeywell, United Health Group, Amgen, Coca-Cola, Lockheed Martin, PepsiCo, and 3M. In total, the ETF has 101 holdings and is curated to include high-quality, large market cap dividend-paying companies. Healthcare is at 22%, information technology at 21%, consumer staples at 16.5%, industrials at 14.8%, and so on. Since the fund's inception in July 2015, it has seen a 52% price return. Additionally, it pays out monthly dividends to shareholders that vary by amount based on the dividend return of the portfolio that month. Here you can see the most recent distributions per share. The annual dividend yield tends to be 2.08%, which is pretty low, but higher than indexes like the S&P 500. OUSA has an expense ratio of 0.48%, which means you pay an annual fee of 0.48% your assets in that fund. This is meant to pay for management fees, administrative fees, operating costs, and all other costs incurred by the fund. This is the crux of why I don't like ETFs and managed funds. You lose a portion of your assets every year to fees, even if the fund loses money or did no better than you could have on your own. In the long term, these fees could be a big cut to total returns. Also, I just like to have greater control over my investments. In these funds, you have no say about what they choose to invest in. For example, in December 2019, OUSA had 9.3% of their portfolio in the energy sector, with 5% total in ExxonMobil and 3.24% total in Chevron. In 2020, they sold out completely and have 0% energy concentration in their portfolio. Now I know that this sector was hit badly in 2020 and their value decreased dramatically, but I think companies like Exxon and Chevron will be able to bounce back in 2021 and beyond. They have strong balance sheets and were able to hold their dividends through the worst year in the history of oil. If anything, OUSA should have reloaded at a lower cost per share. They felt so strong about these companies just at the beginning of 2020. ETFs are unwilling to take short-term losses for long-term gain and have little risk tolerance. The reasoning for this is because they must maintain and grow value for their clients. If they take large short-term losses, then their clients will pull out and will send their funds spiraling down.
Give me my money back.
This is not necessarily a shot at OUSA and more just ETFs in general. I think OUSA is a fine dividend ETF and is ideal for investors who want to start dividend investing but don't want to do their research or pick stocks themselves. If you're not interested in ETFs, there is still value to doing some research into dividend funds. You can look to see what their holdings are, and it could give you a good reference point and ideas for your own portfolio. Although Kevin expresses his love for dividends and invests a significant portion of his net worth in OUSA, he does break his rule about not investing in stocks that don't pay a dividend.
You know, here's an example of one that's turning the corner for me that I'm actually an investor in, Tesla. Why? Because I can now see the path to profitability. I'm up 38% on Tesla. The only reason I bought it is my son got a job as basically an apprentice there, an intern. And I said, Trevor, on your behalf, I'm going to buy a bunch of stock because the stock down 13% today. They had a bad quarter. And within 6 months, the thing is now breaking even. It even looks cash flow positive in a quarter or two. So as a result, the market has regraded that stock, and it's up over 30%. And I rest my case, Your Honor, it's turning into a real company that makes money for shareholders.
Some may call them hypocritical, but I think growth stocks have a place in your portfolio as well. I've been an investor in Tesla since 2016, and it's by far my best performing stock. Additionally, Kevin has another ETF called OGIG. This focuses on global internet giants like Amazon, Alibaba, Facebook, Alphabet, Microsoft, Shopify, etc. This fund is up 112% this year alone. Dividend investing is by no means a religion you must follow exclusively, but it's a good addition to your portfolio and can help you build a passive income stream. Thank you for watching Dividend Data. I'd greatly appreciate if you could leave a like and subscribe to the channel. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. You can support the channel over on Patreon and be a part of helping make these videos happen. The link is in the description. Please leave a comment below, and thank you for watching.